Good morning, good afternoon, and maybe even good evening. Hi, my name is Barnaby Nelson. I'm CEO of the Value Exchange, and it is really fantastic to have you here today, but also to be able to spend the next 45 minutes talking through case for collateral tokenization with a really fantastic group of experts, practitioners, and real specialists on all things that is basically collateral and all things tokenization. So the next 45 minutes is really obviously, as all webinars are, designed entirely to make sure that you come away with as much information as you possibly can. What we're aiming to do in this session is really to cover off three big areas. The first, what is the $360 million ROI business case for tokenization of collateral? Two is, what does the practicality of tokenizing collateral actually look like right now in a world where the devil is in the detail? What exactly does it look like? How and where does it really work? And then, not surprisingly, the third section is really to then spend a little bit of time looking at the tokenization of collateral in 2026. What exactly does that look like? Where do we feel we are on the journey, and what does the runway look like ahead? So, to go through that, we, as I said, have a fantastic group of experts. So just to run through briefly, Amy from ISDA, thank you very much for joining with all of your huge amounts of knowledge on all things. And we will try to get you to talk about anything other than tokenized money market funds, at least for 2 minutes if
My favorite.
you can. Adrian from ISLA, I'm just going as I see on the screen. Not sure what we're going to try to get you not to talk about today, but thank you very much for joining and for being a consistent voice on this for several years now. So thanks for joining in.
Thanks, Bobby.
Sophie from Nasdaq, not by any stretch one of the smaller providers of all things collateral management from a Calypso perspective, and obviously very much engaged. One of the headline grabbers these days, Nasdaq, on all things tokenization. So thank you very much for being here.
Thank you very much.
And Steve, the double hat from representing the digital working group at ISA, and also sitting in Toronto, keeping a very close eye on the Canadian collateral management, as you do every day.
Yeah, thanks. Good to be here.
Thank you very much. So, what we're going to do is just walk through a few stats and figures. As you know, Value Exchange are reasonably quite big on stats. So I'm just going to spend a little bit of time walking through the facts and figures of tokenized collateral, so that we're not too kind of quixotic about this and that we can really drill straight down into the details. So why on earth are we having this conversation around tokenized collateral at all? Just to walk through, starting assumption, the average firm is probably putting and using down about $74 billion of collateral. Obviously, the key word in that is average, but ultimately what we're talking about here is billions of dollars, as we all know, of collateral sloshing around in the collateral ecosystem today. Now, we believe that around a quarter of that is basically subject to one of two different challenges. One is basically the challenge of collateral being too slow to move around without certainty, and so therefore being essentially pre-funded. And the other, a lack of certainty of collateral being there on time, so essentially over-provisioned. So when you actually put those two things together, we believe that, as I said, about a quarter of all collateral around the world is basically is being kind of overused and under remunerated. And so therefore, when we talk about the collateral kind of mobility, what the business case is, we're really zoning in on that part. It's not to say that there aren't a huge amount of other areas around, but based on the survey that this comes from, which is around 200 firms telling us about what their collateral looks like every day, we believe that that's the real core kind of center and zone of this. Now, in terms of key highlights, one of the key reasons why tokenization of collateral is so important is because ultimately it helps to drive a domino effect. And that domino effect, first of all, comes from a reduction in the number of failed movements, failed trades by about 13%, which, as you can see, has, as I said, a string of kind of knock-on effects both in terms of operating costs, but also in terms of balance sheet provisioning and costs around the amount of collateral that we buffer with, the RWA that we have to allocate, the overnight funding costs of a treasury, and so on and so forth. And ultimately, if all of those come to pass, the key thing about tokenization of collateral is that it helps increase utilization of collateral, as you can see, by a good few percent. But essentially, it's going to be great to talk through this with the panel, because I think this, for me, is one of the most important things. It's kind of the gift that keeps on giving, but it's partly characterized as an operational solution, but partly a treasury benefit. And it's that blend, I think, that for me always comes up in our conversations. Now, if you look at how that materializes, that reduction in fails and that kind of trickle down, how does that materialize in an average firm? We believe that, depending obviously on the size of the firm and their activities, we believe that somewhere between, a tier one firm, just by mobilizing that 25% that we were talking about, assuming even just a couple of basis points of overnight funding costs, we believe that an average firm could increase their interest earnings in a year by about $350 million, just simply by actually having that certainty, the reduction in fails, and the certainty of delivery, knowing it's going to arrive when I need it to arrive. Obviously, as I said, that depends on the scale, but ultimately we're talking somewhere between $7 million for a small firm, rising up into what is undoubtedly a really, really compelling revenue opportunity. But I think, as we'll go on to in this conversation, the key is, what does it translate into in terms of P&L opportunity? So those are the kind of the headlines. But I think when we did the research that in at the end of last year, for me, what really, really kind of stood out was not only the $350 odd million opportunity, but how immediate it is. This is a very much present day thing. And as we'll come on to, as we published the results of this at the ISLA Post Trade Conference in London last year, pretty much almost immediately afterwards, DTCC did the next of their test trades. The CFTC came out with their clarifications in December. And then just as we were all kind of starting out the year, the ECB came out and said, okay, we're going to talk about tokens as eligible collateral. So the runway and the kind of, the support for this being a present day thing is very, very clear. So I think when the research came out, we said 52% were expecting to use tokenized collateral in the first in a year. That felt a bit punchy. All of a sudden now it's feeling even more realistic. And obviously we'll talk about that more in a second. So just to zip through, those are the kind of if you only really take away 5 things from at least what I'm saying, those are the kind of the big headlines. But I think just to drill down into two other kind of quick points, what problem are we trying to solve here? So we'll talk about this in a second with Adrian. But for me, one of the root problem here is ultimately an operational problem. Half of the cost of a trade for a collateral movement is manual. And because it's manual, the biggest problem that we have is the risk of the security or the cash collateral not being there when it's meant to be there, quite simply. 70% of the industry say that they have a serious issue in making sure that basically that the settlement of collateral is there. And obviously, it's consuming a lot of headcount to make sure that the manual processes that support that question are in place. What does that mean? 2 corrective behaviors. One is we put in is basically, better early than late. So essentially, we put in too much collateral on a pre-funding basis so that it's there in the account the night before, just in case. So that when we need it for an 8 a.m. margin call, it's there. So better early than late. A lot of that is not remunerated. Only about 30% of it is remunerated on of securities collateral, cash collateral or securities collateral. Therefore, there's a massive, massive performance drag of all the other assets that are being put in too early than too late. Second thing is better too much than too little. So if we're not sure it's going to get there, we put in too much collateral. So essentially, the average firm is putting in 6% more collateral than they need to on an average day. And obviously, again, that's creating a drain on anyone that's really trying to manage their balance sheet on a very kind of precision basis. And so, as I said at the beginning, that equates to, basically about $350 million on an industry basis, billions of dollars. But it really comes down to those 2 points: better too much than too little, and better early than late. And what collateral are we really talking about here? The last thing I want to touch on is the words tokenization of collateral slosh around the industry a lot. The key really is, as anyone who I'm sure many of you would say, working in the collateral space, it's not necessarily true. The same thing is not true for all people. So what are we talking about? First of all, 30% of the industry believe that the tokenization of collateral for repos is the standout use case. Not a long way ahead of derivatives, particularly OTC derivatives, but ultimately repos seemingly, I think because of, well, any number of reasons which we can come on to, have a great outlook, great momentum. And ultimately, when we actually start looking under the kind of hood, what assets are we talking about collateral or tokenizing rather? No great surprise. Tokenization of cash in some way, which we can come on to. Skipping for a second, tokenization of existing HQLA, so G7 sovereign debt. And then in the middle, as Amy cannot wait to get onto, tokenized money market funds. And so for me, I think one of the things, again, what surprised us when we did this research was just how strongly that point, we would have expected the first bar and the third bar. The second bar is really interesting and very exciting in terms of actually what tokenization can do, not just to give us a bit of a tech upgrade, but to really help us restructure the way that we actually manage collateral on a daily basis. I think by extension, the only other thing that we've had as we've debriefed with people on this is just it's not tokenization of collateral is probably outside of Asia. It's less about bringing new assets into the collateral eligibility zone. So it's not about Indian equities or emerging market bonds, for example. Ostensibly not yet. So that's what I really wanted to zip through, as I said, really just in the interest of making sure the conversation, A, just to give Adrian and the others something to disagree with, but also B, just to make sure that basically that we are zoning in straight on the details. So, Adrian, what do you think? We talked about this in 2023 when we first did the kind of look at the overall cost of moving collateral around. We found it to be very manual then. We're saying it's very manual now. Is that the core thing, do you think?
Okay, so before I get to that, you've kicked me off now. So first of all, thank you very much, Value Exchange, for running the survey. I think it was an excellent piece of work, and I'm very happy that not only did so many people, and thank you to the people who responded to it, but also the work you did and how you got the other associations involved. I think that gave us a really good picture to start with. And then also I wanted to say something a little bit about the feedback. So you presented this in a conference last year, in the Isla Post Trade Conference, I'm sure many others as well. Some of the feedback that I got from that, I think was positive, but it was along the lines of, I didn't realize it was such a, that was the picture and also the pace of change. That means I've got to do lots of work in 2026 and 27, I suppose, as well, which will feed into this conversation. So then now I come back to the questions. So you're talking about, is it a central issue? I mean, every single conference rather is discussing collateral and all the challenges around it. There was a really good article, I think it was in the SFT annual, and they described collateral mobility as being like the defining challenge of security finance. I mean, it has been for years and years. Typical things that we discuss in there have been for decades now: regulatory inconsistency, operational risks as well. I mean, we've got lots, and I'm sure ISDA and ICMA are the same, really bespoke collateral schedules, which just make everything more complicated. And then you've got regulations, of course, which are segregating things up, so you can't use pooling effects as well. Infrastructure fragmentation. So in Europe, we tend to use, in security lending anyway, tri-party agents. There are a lot of those now, and you identified, I think, in the survey as well, all the different types of places that collateral exist, which is even more than I thought there was, which just shows how fragmented things are. So that infrastructure issue, and then legals always comes up as well. Is it title transfer? Is it pledge? How do we represent these things? Who can take it? Who can't take it? That conversation is active, has never gone away, and has been going on for decades as well. So there's broadened it, and actually on some of the things you said, I was writing some notes as you were speaking. I think that the manual aspect of it that you called out, I don't think that that's going to become a viable way of operating. I'm sure no one's going to disagree with something like that, especially as we need faster and faster movements of collateral. And then that made me think about what's happening in the T+1 conversation in Europe, because the T1 tends to focus your mind on, do these things really work, and how much manual work is there, how much stuff is there in there. There was a breakout stream in one of the T1 task forces. They identified 13 different challenges related to collateral that would be impacted by T+1. I'm not going to list all of those out, but there was obviously the condensed settlement cycle, the versus payment versus free movements, and the not being aligned as well, the flows between different tri-party agents. All these
Mm,
movements take time to do, and now you've got no time left to do it. So
mm,
other ones like credit lines, which is I think is going to be a super interesting point as we get into what
mm,
happens if we go even faster, which is what tokenization allows you to do. And then on this
mm,
side of the pond, you've got CSDR penalties as well, different cutoff times. I mean, moving collateral around is a big headache as well. So to your
mm.
original question, yes, it is a central challenge. Yes, firms are very much aware of it.
Yeah, no, brilliant, and thank you. And I think what really resonates about that so much is not only the complete complexity of it, but how it just weaves into every other conversation that the industry is having at the moment. This is not a standalone sideshow that's just going on. It's something that, as you said, it touches straight back into the T1 stream of conversation, straight back into the 24/5 clearing. It touches everything, and it's only going in one direction. Yeah, yeah. No, thank you. And so, Amy, I mean, from your perspective, we talk about, the big areas of collateral as being tokenized cash of some description, tokenized money market funds, and tokenized bonds. I mean, how does that reconcile with the 52% in your view in terms of ready to go, ready to run?
Well, I don't want to be a downer because I think we have folks who are very enthusiastic. I mean, we have a working group which I'll mention that is just kicking off that has a great amount of energy, but there are obstacles, and so where we really need to work on is the legal and the regulatory and also the interoperability aspects. But what's driving this is the need to have the right collateral in the right place in the right time. And this isn't just about OTC derivatives in the ISDA world, but ISLA and repo and cleared and futures as well. It's all interconnected, and so it's
Mm.
great to have these types of initiatives where we have more than just one trade association working on an initiative, because when it comes to collateral, it's very holistic. And whether it's Nasdaq and the Calypso service that Sophie provides, or others, we have to make sure that the collateral is being able to be accessed and mobile as much as possible. And that comes down to interoperability, which is driven by data standards. And I'm sure at some point Adrian and I will, and Sophie, of course, will mention the common domain model. But when it comes to collateral, we're seeing that more firms want to use not just cash for uncleared VM, and they want to be able to reuse what they are bringing in. But there are operational challenges such as substitutions, and of course, with T+1, everything has to move faster. So
Mm.
where we are seeing opportunities are, yes, tokenized bonds, and tokenized money market funds. And I, don't want to oversell it, but right now there's just a lot of energy right there of how we can effectualize the tokenized money market fund opportunities.
No, brilliant. Thank you. I think, as you rightly said, even from what we see, I mean, as you say, the interest on tokenized money market funds. I mean, tokenized bonds. I mean, there've been a few around. Digital bonds have been around for a little while, albeit kind of moving into the kind of pledgeability space. But as you said, the excitement around tokenized money market funds as something that's really going to be additive, if we can get this right. And really the thanks to you and the GDF's efforts, being able to bring the right people around the table. There's great anticipation, as you said, many things to be worked through, but great anticipation. Dot dot dot. So, Sophie, in a world of anticipation, details, challenges, as we've been saying, devil is in the detail. 52% this year. I mean, you see a lot of this collateral every day through the systems that you're running for your clients. So, I mean, how do you feel? Do you feel that that number is overbaked, underbaked? What would your sense be?
That's a great question. And well, first of all, thanks a lot for having me today and for having all of us together, with the industries. I think it will take a village to provide the right guidance to adopt tokenized collateral. So thank you very much for that. And well, to your question, yes, actually, I think 52% or more than 50% sounds quite right. We've done a lot of polling from our side. We've organized webinars, partnering with ISDA back in November, December. We've also done polling in the context of client conferences, and usually more than the majority of participants, they plan to be very active in tokenized collateral. And that date of 2026, well, it's now, right? So, but I think it's very much what people are thinking. And diving a little bit into the feedback we're getting from clients in terms of what has to be done to be ready for adoption. What's very interesting, and I think it transpires in the fantastic survey that you just summarized, adopting tokenized collateral is a very, very complex program. So when you look at it, yes, it looks like I would say a traditional program where the regulatory clarity is not there yet. It's shaping up. Every day there is some, or every week we have some news, but we still don't have the clear picture of what the regulation will look like for firms, right? It's a project we know that will require accelerating time to market. There will be a need to change very quickly. There is what we know, what we don't know, all of that. I would say it's a given, and it's very similar to what firms have been used to managing when they manage a transformation program. But there are many new aspects of that tokenization transformation. And I know we're going to talk about some of those complexities later, but just to summarize a couple of those aspects, I would name the first one being that it's at the same time a technology revolution, adopting new technologies across the board, and a functional change, right? Today, the collateral management function, it's taking place once, twice a day. It's very much a cycle. Now we are moving into 24/7, into some type of real time. And I know Amy will correct me because we also need the regulation and the requirements behind that to be aligned before we can decide at what pace we can actually run a collateral allocation flow, right? So there is that component. Then there is the related component that everyone will have to be educated because it's a big change. What we are seeing, and I think you mentioned that in your survey, it might get more complicated before it gets simpler, right? Yes, moving to the blockchain and adopting the new technology will help, but we need interoperability. We need a common data model that Amy was talking about. We need to connect all those blockchains that are popping up like mushrooms those days. So it will be more complex before it is simpler. So it's not a linear progression as we are used to. And the last thing I would mention, as Amy was talking about the user groups and all those communities that are meeting together to plan and define the best practices. That's usually happening when there is a market change. But what is new is the need to work as a network. And traditionally, when we work with clients on new functionality, we work on a bilateral perspective. Now we are working with clients in mini networks because that's what it will take to actually be ready, not just to run the pilot, right, but be ready for production. So that's what we hear from the market, to name a few points.
Yeah, no, brilliant. Thank you. As you can see, I'm taking furiously scribbling down my notes as much as I can because I think, what you're saying, the theme of it takes a village, it takes a network. It's not only very different information that we're trying to consume in terms of what does on-chain look like, what does chain risk look like, all this kind of stuff, but also, as you said, it's not a bilateral, client service provider discussion anymore. It's a properly multilateral discussion. So it's there's a lot of change in there. So which I suppose, Steve, comes through to then realizability of all of this. Amy said there's work still to be done in terms of obviously a lot of clarity that we need to do. Sophie's point about we need the network to move, all this kind of thing. $350 million. I mean, how do you see that P&L impact kind of, how do you see that as a P&L impact, taking into account everything we just talked about, both in realizability and also what's the L that offsets that P?
I think really good questions. And I'm going to answer first with the kind of ESSA hat on. And what we're looking at from an ESSA perspective is how can that be realized, and what are the considerations we have for legal, like finality is a big one. cross-jurisdictional challenges and operational. Without stating the obvious, anyone that's ever done a basic integration of existing technology, it always takes longer than what we think. And with that as a premise, it's realization of this is going to be phased. Is something that I think we're all starting to realize. I think what Sophie said made a lot of sense. It takes these little villages or pods to move the industry forward at the same time. So from an ESSA perspective, the way we're looking at it is how do we present that in our forthcoming paper in terms of what phasing looks like. And because all of this ultimately has to be done at scale, they're very successful use cases done in near isolation. And I say near isolation, it's with very well-defined use cases and very well-defined user groups. But the real benefit of being able to mobilize collateral is when you don't have to think about, hey, I can trade this asset, or hey, I need to use this as collateral. It's where the two interchange automatically, which means your cash equities, your cash fixed income markets, and your collateral markets have to be fully integrated for that to really work. So kind of just switching to my day job on the tri-party side is I think on the bilateral sense, a lot of the numbers you're seeing there make a lot of sense. Tri-party is obviously an improvement on a lot of that, where I think we're going to see a little bit of a phased approach. And going along the lines of what Sophie said is that effectively what tri-party does, it creates little communities, and those little communities can create the hybrid worlds between TradeFi and DeFi. And as the market starts evolving, and I think really the key here is bringing on the cash rails, which we've spoken a little bit about, because as soon as those cash rails are there, we have the ability to properly integrate TradeFi and DeFi in a meaningful way.
No, brilliant. Thank you. Yeah. And so, look, I at the end of that kind of first chunk, I mean, it doesn't almost need summarizing, because reactions to, I suppose, to the research overall, it takes a village. It has to be the strap line, work needed, phased approach, key letter missing there, and ultimately this is a non-linear. This is a network play. So I think hopefully. Very, very little to summarize there. But I think if we come on, one thing, thank you very much for people sending through their questions. We've got a good few coming through, which I'm going to drop in as we go a little bit, and then we'll sneak a few in at the end just to keep everyone on their toes. But when we start talking, we've already gone towards the practical points. Amy, you hinted at some of them. Steve, you were mentioning the cash rails. I mean, Amy, from your perspective, one of the things that we found as we've debriefed, and we've already kind of alluded to this, is that there are, as Adrian said, there's thousands of different types of movements of collateral all day. Some working pretty okay, some really, really not. And I was curious, if not all collateral is created equal, where do you see the real kind of hot spots that, we believe that tokenization can really, really have an impact on?
Sure. And so you mentioned, you and Adrian, of how some things are working well. So, for example, once the uncleared margin rules came into play, initial margin and both variation margin, those collateral movements, they increased exponentially, and firms needed to be much more efficient. And so there are workflow automation improvements that have come into play in the past 5-7 years, and we're thankful to them. But some still haven't, such as substitutions and the process of, you call it remuneration, I call it rehypothecation. Sorry, your R word is hard for me to pronounce. But the operationalization of that process outside of the tri-party world is still very manual. And so, going back to your study, and I think one of the questions that came through is, why is there still firms who are not rehypothecating? They may be receiving non-cash or even cash, but they are not reusing it because the process is so manually intensive. If they need to get it called back, there could be fails and there's failed charges. So there's still these opportunities for improvement, and the operational efficiencies that tokenized collateral can bring, along with the near instantaneous settlement, can really improve the operational challenges along with the liquidity benefits. So I see some great opportunities there. There are some types of collateral that are not used, even though they can be, whether it's in the uncleared margin world or, for example, money market funds are allowed to be used for initial margin and cleared. They're allowed to be used for uncleared margin in the US and other jurisdictions, but they are not because of the current challenges that you have to redeem your money market fund shares, post the cash, and then you put it back into a money market fund with your custodian sweep. And there are a number of reasons why that doesn't work today that can work in the future with tokenization. So that's why we're seeing some great opportunities in the tokenization space across products.
Yeah, no, brilliant. No, thank you. Yeah, absolutely. And so I guess the other angle of this is then, we talk about tokenization bringing certainty, but of course the other thing is it brings, to Adrian, to your opening point, brings a 24/7 clock. And one of the things that I think that has been originally kind of brought out was, gosh, it's going to be amazing. We're going to have 24/7 mobility of collateral. I was curious, Sophie, from your perspective, really? I mean, in as much as, do we really want 24/7? Because so far what we've kind of talked about is, as you said, Amy, the kind of the facilitation of greater activity based around certainty. But that can all happen within the existing collateral runs. Do we see a massive pull? And how do you find firms are moving towards kind of 24/7, if at all?
Yeah, it's a great question, right? Who wants to be working on a Sunday morning? That's some of the answers we get. And before I answer your question, I just wanted to echo on one of the points that Amy made about, what works very well. And I would like to highlight that, Amy mentioned the uncleared margin rule, and we've actually been able to test that the ISTA-SIM model that was initially not really implemented for crypto products is working very well to calculate and optimize the exposure of those products. So thank you, ISTA, for kind of setting the way to be able to manage exposure, which is a big part of that kind of a collateral new ecosystem, right? And I think so, to answer your point, 24/7, what the industry is going through is trying to converge two worlds, the traditional assets worlds and the digital assets worlds. And on one hand, you have the traditional players, working Monday to Fridays with fixed hours, and we have the fixed cutoff, and we have the constraints that come with it. And then we have that, digital assets world, which is completely opposite. It's open all the time. It's fully real time. And what now firms have to decide and adapt is how they will make the best of both worlds. Of course, by also following what the regulation is telling them, and what is a way for them to be resilient and to be on the safe side of managing counterparty credit risk and the corresponding collateral management function, right? And what will actually be very important in that journey is to make sure we don't lose track that when you move collateral around, when you manage collateral, you are dealing with counterparty exposures. Whether those counterparties are managing digital assets, traditional assets, at the end of the day, it's a single exposure that has to be taken into account, and it has to be done from a consolidated perspective. So yes, there will be changes, and there will be adoption of new models, as Amy was mentioning, the common data model. We're going to leverage decentralized blockchain rails and applications. At the end of the day, it will all have to fit into that consolidated ecosystem, because the goal we have is to manage counterparty credit risk with a more efficient collateral management function.
Yeah, absolutely. So very gentle way of saying probably not racing towards 24/7. But I think, I mean, at the end of the day, I think you're right. This is about dealing with fundamental challenges. Adrian, what do you think?
So, I mean, 24/7, just, I'm that old school. It was blowing my mind just thinking about it, and just talking to people. There's a few things that I struggle with. First of all, is today's infrastructure that was built around having some sort of batch process happening at certain points in the day, and then that makes me immediately think about legal documentation, which we're already struggling with. As we're writing our master agreements. We've already had one copy come out, and it was about tokenizing legacy instruments, and now we're thinking about natively issued ones, and we're getting right back to fundamentals like when's close of business, when's this, what are the times associated with this. Now how do you match up 24/7 to this legal construct if there's an end of day, or notification can happen before close of business at wherever the recipient of the notification is. I don't know how you manage all that stuff, and also the concept of netting, the credits that you need to have to be able to move that amount of collateral around if you don't have the netting going on as well. And then the other one that comes up is something along the lines of what if it goes down type of argument. I mean, the typical. So what's going to happen here is you've got fantastic technology which allows you to scale things up. Whenever we in the past have had something that's gone down, you throw lots of bodies at it, and people in different departments come across to help those out. There's not going to be enough bodies around to cope with the scale that we're talking about. So, I mean, and those discussions, that's there's own thoughts. That's discussions I have with firms, but also that's happening in the regulatory space as well. So, lots to
24/7 trading needs 24/7 risk management.
Yeah.
And I think this is the challenge, isn't it? That essentially you've got on the one hand, as we said, crypto markets and other markets, you've already got 24/7 markets out there, and now we've got these traditional markets that are kind of pretty slow and sluggish by comparison. But as you said, Adrian, there's a lot of reasons why to go from there to there. There's just a lot of stuff that we've got to work through, and every single one of those decisions for me is going to have its own P&L. And as a result, to your point about a phase transition, it's going to make sense for different people in different activities at different times to go on that journey. But it's for me, they're all of the points you made are absolutely golden in terms of why you would need to think twice about some of the things, not just 24/7, but even tokenizing. There's a lot of risks that I think we're highlighting through this conversation that really need to be borne in mind. And I think, we touched on legals, and actually before we look at the kind of current outlook, Steve, just a quick thought. Now you're allowed to speak as a CSD, but the who tokenizes question, for me really comes out quite consistently about, how do we manage the whole question about who the token is coming from?
Yeah, it's a really good question. I think secularly we're seeing two trends, generically speaking, particularly on equities. Like you could have this idea of, well, the old traditional TA could be doing, the initial tokenization versus a CSD. I think where it sticks to the traditional CSD FMR model is particularly around fixed income and the collateral use cases, because that's where everything kind of converges. So I think that taking the whole market together at the same time is the common theme that we're hearing, because there is a transition period. So I'll give a really, really simple example. The liquidity you require today in the settlement world for fixed income and or equities, doesn't just necessarily disappear in tokenization. It simply moves. It's transitioned, or portions of it, to the ecosystem you're moving to. So managing that, and I think Amy had a really good point, what actually really has to improve is the risk management around those two. Because as tokenization gets bigger, you've still got elements of TradeFi that are working at a different speed and with different restrictions. And then with tokenization, you also have, it's always such an interesting concept as tokenization. The features are because of the technology, and the feature, when I look at really great networks out there, like something like a Canton or whatever, these provide like safe networks for a lot of these to go into. But our world is about to become a lot more complicated. There are more networks, more ways assets can move. How to manage liquidity and substitution across a complex network of chains becomes something else that as a market, particularly domestic markets, you kind of going to have to say, well, okay, how are we going to manage this if we're simply wanting CCP margin that could be reused, from a different jurisdiction? What are the parameters around that? And as an industry, defining what those goals look like and the metrics. And the one beauty of tokenization is you can automate a lot of it. So I think there's pros and cons on both sides. The key message is moving along, having open dialogue, and making sure everyone is involved in each step.
Mm.
I
Okay,
think Steve
brilliant.
makes a very good point about the automation. I mean, we really can't embrace tokenized collateral unless we embrace automation, interoperability, data standards, and smart contracts.
Yeah.
They all tie together. Because if we're just moving collateral faster, but yet we're doing everything manually and we're not using standardized contracts that can be productionalized in an automated fashion, then we're really missing the boat here.
Yeah,
And I think
Oh, sorry.
sorry,
Just
Sophie.
wanted to add just one answer, but yeah, I fully agree with what Amy was saying, and I think on top of those automated tools that we've talked about, and in order to be able to be open 24/7, we have a great ally, and it's AI, right? While people don't want to be working on Sunday morning, we can expect the digital workers not to complain about it, and that's going to be the holy grail of using all those automated tools that Amy was mentioning, right?
Yeah. Absolutely. And I think for me, there's two sides of your comment, Amy, because I think automation is a prerequisite for much of this. We can't be running, I mean, if you think just, for me, corporate action, if it still has to go out by fax, then realistically, you can tokenize whatever you like. At the end of the day, it's still going out by fax, even for a token. But ultimately, I think one of the questions that came in was also, if we do this right, it's not just about moving around faster that we get, and part of the study actually we skipped over was, there are many benefits that we're talking about for tokenization, that of which really the mobility and the security is just the top, but regulatory reporting, automation of substitutions, workflows, there's a whole cascade of benefits that come through. So you're right, we can't be completely myopic on that. But as you said, Adrian, at the beginning, I think the key is just making sure, well, let's at least make sure the first one comes through and then we can worry about the rest. So 2026, we thought we were having a quiet year. We knew that the CFTC was involved. We knew the DTCC were involved. We knew a lot of people were involved. So maybe actually, Sophie, do you mind just giving us a quick sense check of where you feel basically we've kind of got the momentum in the industry today? And then maybe we can just have a quick moment, look ahead at basically then what lies ahead. But where do you feel the main tracks of kind of momentum are from what you're seeing across your client base?
So I think given the recent updates we got both from the regulators around the world, and also thank you very much, ISDA and ISLA, for providing your guidances as well. The industry is now getting ready not just to run pilots, but to be in a pre-production phase. And I mentioned earlier those mini networks. We are really simulating running at small scale what will need to happen very soon, and that's what 2026 will be about. And I mentioned AI a minute ago, and that's really the path forward. As you know, every firm is building their AI foundation as we speak. And if firms want to achieve full automation, being open 24/7, that's the way to scale, right? So I think we'll see in 2026 more emphasis on building the foundation to be ready around AI, around the tools, and actionable initiative so that it can actually happen. And to Adrian's point, we have to start small, we have to start somewhere, but it would happen this year. So that's what we're going to see, maybe being more pragmatic while being holistic in how we move that collateral management function to the blockchain, and how we bridge the traditional and digital worlds.
And so, Adrian, with that in mind, I mean, in the spirit of pragmatism, what do we need? What are we waiting for? What do you think the big things are that, I mean, we talked about a lot of behavioral challenges, but ultimately, why are projects getting stuck, do you think, at the moment, or held up?
So I'll do it really quickly because I noticed the time. So we've got the regulatory frameworks and compliance, infrastructure developments, and I think we've covered some of this already. Technology advances, and I think we've covered that as well, and market development. I completely agree with Sophie with your points, and it's with anything is you find the use case and then you apply it. Otherwise, how can you justify it? Justify the spend? So they're the main things that get spoken about.
Yeah. And so, Amy, just a quick word on the big announcements, 3-letter abbreviations, 4-letter abbreviations. What effect do you think the various, as I said, so CFTC, DTCC, ECB, that's what a 11-letter abbreviation. What do you think the
Well, you have to
combined
add in
impact?
SEC was the no
Sorry,
action
yes,
release for
you're right.
DTCC. Yeah,
And
so
the
those will be
SEC
similar.
actually no action letter. So in fact, you've got a monster of all letter
All sorts of
abbreviations.
letters. What I think that demonstrates is the regulatory spirit, the regulatory energy, and you marry that with the business need of improving liquidity and reducing operational costs. And as we've all mentioned, there is a lot of excitement about tokenized collateral. And yes, we need many parties. In our US tokenized money market fund working group, we have about 265 firms, individuals representing about 135 firms. So, but we have a narrow focus of US tokenized money market funds to be used as collateral for repo sec lending, cleared and uncleared, across the product gamut. But tackling the legal, the regulatory, and the operational aspects. And there will also be a sandbox. So, it's not just proof of concept, it's near production. It'll be test data, but it will be real life scenarios across the products and across the workflow initiatives for collateral as well. And I think we'll see more of that. That's just one project that ISDA's teaming up with Global Digital Finance.
Yeah, no, brilliant. Thank you. So, Steve, maybe a quick word from you then to round it off in terms of actually how do you see the runway? I mean, in terms of big things that you're watching for the next few months and things that we should be paying attention to.
Yeah, I think it's the productionization of a lot of the use cases we're seeing coming out, the learnings from those. As I mentioned, the more it gets integrated into real life mechanics, into real buying and selling, what happens as you start expanding these market timelines and liquidity pressures. And I don't want to be the person to say it, but we haven't had our moment yet where something goes wrong. It's going to come in some shape or form, and we're going to learn from it, like we've done in every other situation. But to echo Amy's point, I think risk management really is the key player here.
Yeah, brilliant. No, look, and I mean, I think from our experience and our research, about 70% of every tokenization digital asset project is about operational risk and compliance kind of. So I think, as you said, we have to tread carefully, but many dependencies, much work to be done, but a genuine sense, as you said, from the regulators, from the participants, that there is momentum here. And that ultimately, not only has Amy got to bring back some wonderful results from the Tokenized Money Market Fund Working Group, but ultimately, there's genuine sense that we've got a lot to look forward to here. So my apologies to the people who've asked the questions. We will email you each individually where we have your details to make sure that you get some good feedback. But thank you for really fascinating conversation. I listening, certainly there's a really strong sense that there is, as I said, there is momentum. There is work to be done. This is going to challenge us, but there is nothing here that we've discussed that is not worth the effort that basically the tokenization seems to present by way of potential spoils. So, it definitely seems that anyone coming out of this call who is saying not now, not me, can't be bothered, you're probably in a shrinking minority, if that's the right word. So please do reach out to Amy, Adrian, Sophie, and Steve, and obviously myself if you need to for any questions. But thank you very much to you guys for a fascinating conversation today. Really, really exciting. So thank you.
Thank you.
Thank you, Barney.
Thank you very much.
Great. And thank you all, everyone, for listening. Have a very good morning, afternoon, and maybe evening.